Hi, and welcome to Property Plant and Equipment module. And here we're going to go over a couple of concepts regarding property, plant, and equipment. Mainly, we're going to go into acquisition cost, on how to figure out your cost basis for the land or property that you acquire. We're going to go over interest capitalization in terms of how much interest you can actually include in the cost of the asset as well. And we're going to go briefly into equipment exchange and the journal entries that are required in order to record gain-loss on equipment exchange and how that triggers gain or loss. So starting with acquisition cost, we have a company here, Boyd Co., and they purchased 4,000 tract of land. Now the question is, which of these pieces are included in the cost? So think of it as a cost basis. It starts out with 400K, right? This is our base. And what do we add to it? We can add demolition. We can add to it legal. We can add to it title, right? And we can also, the idea is proceeds from salvage materials actually reduce it. Why? Because it's a revenue. So everything else is a cost, so it's costing me more. I have more, right? So it's costing me more. And if you sell something, it's costing me less. So the answer here is just 400 plus 50 plus 10 plus 12, and then this is a minus 8. And if you add all those up, I believe we get 464 as the correct cost, right? And now moving on to the next question, what I want to go over now is interest capitalization. And the idea here is, I want to start with a smaller one first. We have Clay Company building a new office. And the total cost is $2.5 million, and $2 million was incurred this year, right? So whatever is incurred is what is applicable to interest capitalization, right? It was spent evenly throughout the year. Evenly means we can say $1 million in the beginning and $1 million at the end. That means evenly, right? So the idea is the weighted average spending was 2 million divided by 2, right? So the average spending was 1 million. And the question is, what is the avoidable interest, right? So we can say the avoidable interest is the weighted average 1 million times the applicable rate that we have on file, which is 12, right? So we have 120K, which is our avoidable interest, right? Because that's how much, if we didn't construct this, if we didn't build this, if we didn't borrow this money, that's how much interest we would avoid, right? But the idea is that the total amount of interest incurred by Clay in year 4, the actual was 102. So we take the lesser of 102 and 120, because what the debt that actually had outstanding at the time is different. So their expense was less. So the lesser is actually 102. So that's the correct answer. You always take the lesser of the avoidable and the actual, right? Now, moving on to the next question, I wanted to go over an exchange question. So we have March 34, Wind Company traded in an old machine having a carrying amount of 16.8 and paid a cash difference of 6,000 for a new machine having a total cash price of 20.5, right? And the cash flows from the new machine are expected to be significantly different from cash flows from the old machine. So that means there was commercial substance here, so we can recognize gain-loss right away. what amount of loss should Win recognize on this exchange? So the rule is loss, we can recognize the whole thing right away. So with Win Company, we have here Win Company. We have here, and it traded in a machine, right? So the Win Company sent over to the other side a machine with book value of 16.8, right? 16.8. And it paid cash difference of 6K, that's fine, right? And what it received, what did it get? What did it receive? It received a machine having a total price of 20.5. So 20.5 is what it received. All right, so now we're saying what amount of loss should be recorded. So first, what I wanted to show you is that if you receive something that's worth 12.5, right, and what you gave essentially was 6 in cash and a machine, what's the fair market value of this machine? We know book value is 16.8. The fair value of both of these must equal 20.5. So if I take 20.5 minus 6, right, I have 14.5. 14.5 must be the fair market value of what Win is giving. This is the fair market value. So this is the fair value of this machine. Now, if we have something that's on the books at 16.8 and something whose fair value is 14.5, right? You know, the idea is, listen, it's like I'm holding something that's worth 14.5, but it's on the books at 16.8. Now we triggered an exchange, so we have to account for this difference now. This difference is 2.3 thousand. And once the exchange occurs, we recognize the 2.3 as a loss, right? We recognize it as a loss because we got rid of the machine and, you know, it was worth 14.5, right? And we recorded the loss.